Chinese stocks are heading into orbit, and doing so in the most unconvincing way. Even the Western mainstream media, which is normally one to cheer on everything that the government in Beijing does, especially as far as stimulus, even the Western mainstream media is like, yeah, this is a big time stock market bubble. But in all that, there is a signal that we need to pay attention to in this Shanghai rocketing of share prices. The word everyone is using is disconnect, as in Chinese shares have become wholly and completely disconnected from any rational sense of economic fundamentals. Meanwhile, stocks in the Western world that have already done the same thing are somehow taken as proof the economy here must be doing quite well. Maybe that's the real disconnect. In fact, China's share boom right now is actually further proof the Chinese economy, and by extension the global economy, is in really bad shape, which makes it highly reminiscent of the epic 2015 stock cycle and to an extent the Shanghai bubble of 2007. It's a combination of late-stage cycle behavior, the belief that the worse it gets in reality, the more the government will have to forcefully respond in somehow, some way that will be good for equities at some point. And that belief is sustained for a while, like any bubble, running on pure momentum, which, given the recent surge and what seems to be behind it, Shanghai definitely has momentum on its side for the time being anyway. But Chinese stock bubbles, more than most, tend to meet with reality in rapid fashion once the momentum is exhausted and a more rational view of the world begins to prevail. It's not as if Chinese stock speculators are riding some minimal pickup in economic activity as a catalyst either. On the contrary, the economic data, and especially where it comes to real estate, hasn't changed at best, with more than a few major accounts like retail sales and fixed asset investment taking a nasty, ugly turn this summer. But that's the signal. The uglier it looks like it's going to get in the near term and then longer term beside, the more appealing Chinese shares seem to be as an alternative to everything else. Why not give the casino one more spin? Because everywhere else you look, it's a losing proposition, including in the real economy. You can look at the various stock indexes in China, and they're all basically the same. Chinese shares were the worst performers up until January of 2024. Then the government stepped in with a bunch of measures aimed at propping the market up, improving sentiment, harassing investment managers to buy rather than sell. And it stopped the long-run slide. And then China's bazooka last September sent shares soaring on hopes this time it might actually work, even though it didn't. Yet the constant drumbeat of more support since then from Beijing on everything from housing, the economy, banks, more for equities, it kept the stock market treading water even through the first phase of the 2025 trade wars. Now, there was a sharp sell-off in April like everywhere else, though even less short-lived. Once prices recovered in China, it was sideways again up until middle to especially late June. Suddenly, buying interest picked way up right when the economy began to fall way off. And the timing leaves us little doubt as what the catalyst had been. It was the US-China sort of trade deal, which basically agreed to de-escalate the situation from most of the worst cases. While it didn't actually solve the matter, it's been delayed several times, it effectively postponed the final details, and for Chinese stocks, why not? It's a clear buy signal. There's also little doubt about the source of this share price surge. It's coming from especially Chinese households and retail investors who are leveraging up through margin debt. They are exactly those who have been slammed for years by the property bust and sliding home prices. Despite everything Beijing has thrown at the problem, nothing seems to work and nothing is likely to work. So you can see what Chinese savers have done. They're looking for an alternative investment class which is not rotted out on the property developers or the banking sector for that matter, or the general industrial malaise. Why not equities, especially in China tech, since there's a booming AI bubble everywhere else? After all, the government is shooting for a new economy based on sci-fi levels of technology. Why not try to catch the wave in its relative infancy? If nothing else is going to work for investors in the real economy and related to real estate, why not give the stock casino another spin? But like I said in the intro, even the mainstream media in the West, which is always in favor of any government measure from Beijing, even the mainstream media in the West is like, hey, stocks are getting a little bit out of control here. Here's Bloomberg last week. Red flags are emerging in China's onshore stocks following a surprise rally, mostly driven by liquidity rather than improved economic fundamentals. However, measures from valuations to technical indicators and margin financing are beginning to flash warnings. Warnings that are in many ways related to the AI bubble that we see everywhere else. Why not turn Shanghai into China's version of the NASDAQ? Going back to Bloomberg here. The Star 50 index, which offers heavy exposure to chip stocks, has been the most glaring example of the latest rally. Nearly 2/3 of its members are trading higher than the upper Bollinger Band, a popular volatility gauge to determine if a stock market is over or undervalued. And we should also note that a lot of this is taking place on margin. Margin usage has also soared, with outstanding stock trades using margin leverage only about 6% below the peak that it had attained back in 2015 during that bubble. And here's the South China Morning Post. In a report on August 8th, Morgan Stanley noted that the MSCI China and Hong Kong Shanghai Index were the world's best performing equity markets in the past year, and it's only gotten better over the month since then, or nearly month since then. Yet with onshore stocks adding almost $1 trillion to their market value in the last month alone, and then another trillion on top, doubts are creeping in about the sustainability of the rally. Some of the most important factors behind the long bear market in Chinese stocks up until recently, the pervasive weakness of domestic demand and the housing crisis, those are still present. Bank of America points to, quote, the great divergence or disconnect between China's prolonged economic downturn and a buoyant stock market, while Societe Generale says the Shanghai Composite Index is already in bubble territory on some metrics, and it may not just be some metrics, it may be on almost every metric. Nomura sees, quote, widespread evidence of a sharper slowdown in domestic demand in the second half of this year, talking about the real economy. However, it conducted a survey of investors which found that only 29% of respondents believed the rally in onshore stocks would peter out next month or sooner, while 36% predicted it would last beyond November. And that's a common theme everywhere, not just in stock bubbles, but in the stock market itself. Momentum rules everything. And once it really starts going, whatever the trigger might be, it's the old Keen's beauty contest. When everything looks beautiful according to everybody else's opinion of everybody else, stock markets can run regardless of any fundamentals. In fact, stocks and fundamentals are rarely in close proximity to begin with. And in China during these periods, fundamentals don't matter at all. What does matter is this ongoing pervasive belief that it's gotten to be so bad, the government's going to have to come in just like in 2015 and do something radical to try to shake everything up. Even though every time the government does this, because it does so repeatedly, it doesn't actually work. So it is a spin at the casino because you're really betting that maybe this time will be the one time that it actually does work. If you want to stay up to date and informed on the biggest stories that happen each and every week, then Eurodollar University has the subscription service for you. Over at Substack, we give you the one big weekly thing. We tell you what that one big weekly theme is and then draw from all over the Eurodollar University universe, whether it be the deep dive analysis, the daily briefing, or other material that I put together, including here in YouTube and some other places that you don't get access to give you the background details, as well as why the one big weekly thing is so important, what makes it that one big weekly thing. So head on over to Substack to sign up. There's a link in the description here. We've got a special annual price ongoing right now. Also, you get a chance to sample the work. So like I said, head on over to Substack. There's a link in the description. The one big weekly thing that you don't want to miss each and every week. If you look at the economic situation, it does not work. And a big one, as I mentioned before in a recent video, retail sales fell off in each June and July after rising in May, due entirely to government subsidies for appliances and electronics. Consumer spending had already fallen off pretty significantly earlier in the year, meaning May's splurge was a one-time, which ended up pulling forward demand, stripping the summer of it, and leaving China's economy in a deficit already, just getting into the key summertime months. Industrial production in China slowed, though there are still signs of a lingering trade war and tariff-beating distortions, which are not going to last for all that much longer. And maybe the biggest one of them all, as far as China's big three statistics go, fixed asset investment appears to have crashed both in June and July, putting the economy into the crosshairs of a property bust all over again. Fixed asset investment slowed way down on an accumulated basis, and when you do a little bit of math, you find out it was seriously negative, especially July alone. Even the unreliable chain monthly figures from the NBS were negative in fixed asset investment. So no effect from the bazooka last year in the real economy. Same thing, if not worse, in terms of property, real estate, and housing. The latest housing statistics are not looking good. In fact, they're looking like they're rolling back over and heading into the middle of 2024 territory all over again. Yesterday, China Real Estate Information Corp reported sales that were booked by the country's 100 largest realtor firms stood at just 207 billion yuan, which was down a whopping 17.6% from last August. This was in spite of two of China's biggest and most important cities, Beijing and Shanghai, both of them easing home buying rules last month. In reality, those are just the latest policy measures in a long line of failed housing rescues. There had been some hope the market was turning around late last year after the bazooka because home prices started to stabilize, as home sales actually perked up a little bit last October, the month following the big stimulus announcements. Sales volumes went back and forth around zero, but with February being slightly positive, the last month to really be positive, it only turned around in March and then crashed once again, starting with June and July. So the economy isn't improving. The best anyone can hope for is that maybe it remains on a stable and manageable downward decline. And a lot of evidence is coming in showing even that's not a great bet. So if the economy is awful and real estate is dead or worse, why not give stocks a try? The worse the economy gets, the more likely there will be more quote-unquote stimulus, and you never know, maybe the next one will finally be the magic right combination and lift China out of its long-running recession. Just stay away from banks and property, favor tech or anything AI, and boom, you got a bubble. But it's one that we've seen in China before. Too many parallels to the previous bubble back in 2015 or the one before that in 2007. Much of the same setup and therefore likely the same implications and inevitably the same ugly end. So focusing on the last one, 2014 and 15, all of this, especially the background, is going to sound really familiar to the last couple of years. Chinese stocks, like the Chinese economy, were coming off a brutal couple of years. The widespread belief had been the country would emerge relatively unscathed from 2008 and ascend to the top spot in the world's macro and financial hierarchy. The 2010s belonged to Beijing, so everyone said. But it was becoming very clear by 2012 that wasn't going to be the case. On the contrary, China being the factory to the world for consumer goods, the only way left to achieve supremacy was for somehow either the global economy itself to fully recover, that maybe the 10th dose of QE might finally work, therefore restore broad demand to Chinese factories and workers, or that the Chinese themselves would offset permanently impaired external demand by an equal, if not better, rise in internal activity led by consumers. Authorities even gave this transformation a name, calling it rebalancing, at least in English. But by 2014, either of those scenarios was priced into real markets, especially bonds, as a growing pipe dream. It was only politicians and central bankers who saw it differently. Thus, why China proceeded with its real estate bubble, which otherwise served no true purpose. There would be no rebalancing. And everything finally came to a head in late 2013 and early 2014. Back in 2013, authorities had compounded the growing sense of dread by allowing the first corporate default under the then operating model of socialism with Chinese characteristics as expressed by Deng Xiaoping. The previously invulnerable yuan reversed course against the US dollar as providers in the dollar system, the Eurodollar world, understood only too well what was happening. Massively higher risk and fundamentally zero upside left in China. CNY, by the way, has never come back from then, very accurately reflecting these long-run circumstances and ongoing long-run risks. But heading toward the middle of 2014, the situation was looking increasingly bleak for investors inside China too. Bond yields were tanking, the economy increasingly soured. Then along came what appeared to be a lifeline. The PBOC announced it was going to be handing out a massive 1 trillion yuan, sound familiar, in special funding for China Development Bank under something called the Pledged Supplementary Lending Program. Shanghai stocks didn't just surge, They quickly shed any connection to reality, however tenuous it had been to begin with. With the PSL, Chinese stocks were seen as the last possible decent place to generate returns by betting on the future success of what appeared to be a huge break on stimulus, even many people calling it money printing or a stealth QE in China. We all know how stocks everywhere love to respond to the idea of any QE, real or not. But for all the hype surrounding this and the growing rescues that sprang up during 2014, and there were a few, credit markets and external participants remained hugely skeptical throughout, more often correctly looking at any increase in quote-unquote stimulus as confirmation the last dose had failed, and the next dose is simply more of a response to that worsening weakness. So Shanghai shares came to be the last hurrah, the final outlet for pent-up investment, one last spin at the casino. And the worse it got in China's economy, the more it seemed like the Chinese government would be forced to fix it. Everyone in stocks believed, authorities had the power and only had lacked the will. So the worse it got, the more Beijing would have to come to the rescue with its big guns. But as it turned out, China didn't know how to fix anything. Chinese stocks soared to incredible heights on leverage and momentum, then crashed back down in seemingly the blink of an eye, the entire bubble lasting not even 2 years start to finish. As for China's economy, it was a phase shift in 2015, a step down, which only preceded more of the same yet to come over the years following then. Speculators and households took a spin at the stimulus Shanghai casino and lost in pretty epic fashion. Now they're back doing it again because it's starting to look much worse in China here in 2025 than it had been even in 2024. Maybe that means, at least according to the rationalization, an ever bigger bazooka. So hey, nothing is impossible. Maybe this time if they go even bigger, something actually sticks and something actually works. I mean, if they're rationalizing here, the rationalization at least makes some intuitive sense, or at least it sounds like it does. Why not give the Shanghai casino one more shot, even if it is a long shot? It's better than investing in, say, real estate, where most Chinese do, that just continues to decline and fail year after year after year, with the economy offering zero support. So it's a long shot Hail Mary, but it's better than what there is as far as alternatives, especially the worse it gets in China, the more likely that might lead to a Beijing response, and maybe, who the hell knows, maybe this time it actually worked. Like I said, it's a long shot, but it's better than the near certainty of failure in real estate and the real economy. So here they are all over again. Chinese stocks have been rising since the start of last year, betting one failed stimulus after another will somehow yield a magic one if the whole situation gets bad enough. In that perverted way, the more everyone piles into Shanghai shares, the worse you know it must be getting. They're all betting on AI combined with a bigger bazooka because everything else in China, from the real economy to real estate, is sinking and maybe even much faster. Bigger picture, it's yet another example of how Chinese stocks can so quickly and completely divorce themselves from reality, while also reinforcing the same goes for equity prices and the fictions of valuations everywhere. Stocks are not the economy, nor do they often reflect those fundamentals. They really are the casino. And in China, when things get bad enough, why not give the wheel one more spin? Because, hey, you never know, and what else is there? You know what else is an unmistakable signal things aren't going in the right direction? When Federal Reserve policymakers start to make a lot of sense on major issues like the real economy and the labor market. Went over that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.